Camelot Biochem. Go long, $200 million.
Camelot Biochem is getting acquired by Far East PNC at over $100 a share in cash and stock.
Axe is gonna make
Close to $100 million profit on a dirt trade.
Let's talk about finance lessons from the 9th episode of Billions based on my work experience at Goldman Sachs in New York City and based on my work experience at the top hedge funds in the world. Now, please be sure to comment, like, and subscribe, and stick around, because at the end of this video, I'm going to grade the episode for Wall Street realism with a buy, hold, or sell rating. 3 key topics in this episode that we will discuss are: number 1, Axe Capital's $100 million profit on a trade that involved insider information, and exactly how a real trade that is massive is executed on Wall Street. The second topic is about the Occupy Wall Street movement, and how in 2008, the financial crisis led to finance companies getting unfairly bailed out, and why this led to many arrests of hedge fund billionaires and a massive Occupy Wall Street or Occupy Westport movement, in this case with Axe Capital. Topic 3 is how a bunch of Axe employees secretly quit at night to start their own firm, and why Axe Capital is getting massive redemptions, and how the hedge fund industry deals with non-compete agreements if you try to quit. Topic 1. Axe has portfolio manager Donnie execute this massive trade.
Camelot, I just placed an order for 1.8 million shares.
Kaboom!
There's another 800,000 shares on this ticket. Can you get them in for me?
You know I will. Give me some ups.
Thanks.
Now, the only realistic thing about that scene was the portfolio manager Donnie not being that friendly with Maffei, who's a trader. Now, aside from that, there are many inaccuracies about the trade he just made. Number 1, per this order entry screen here, he would never place a $136.8 million trade through just one order, as other investors would find out immediately about the massive order and immediately drive the price of the stock up. Ideally, Donnie would not make this trade, as it's the job of the trader Maffei, who's smart enough to place many smaller trades with different sell-side firms like Goldman, Morgan Stanley, etc. This way, the likelihood of word getting out that there was a massive buyer is less likely. As we can see here, the order was a market order, meaning it will get filled at the latest price. So this assumes that the stock is very liquid, meaning the difference between the bid and the ask price is narrow, which it could be. And the reason why they might use a market order instead of a limit order at a certain price limit is because they know that big news is coming on the tape, like M&A is going to hit the tape soon, which of course is insider information and is illegal. Now, since this company is about to get acquired and it trades a lot, let's assume that it's a mid-cap company. Could a mid-cap biotech trade that much in a day? Let's see. Let's go to Yahoo Finance together, and let's enter the ticker of a biotech ETF. We'll use Cathie Wood's ETF of ticker ARKG. And let's now go to holdings. And let's pick CRISPR Therapeutics here. And we see here that the market cap is $7 billion, meaning it's a mid-cap, because mid-caps have market caps between $2 and $10 billion. And here we can see the stock is at $89, and the average volume is 2.7 million shares. Alexa, what's 2.7 million times 89?
2.7 million times 89 is 240.3 million.
Let's call it 240 million. Now, since the Camelot order is $138.6 million, and this stock CRISPR trades about $240 million per day on average, then in this hypothetical Camelot example of $138.6 million, that would be over 50% of the daily volume. And it would be hard to fill that order by sending it through one broker without pushing the stock up quite a bit. And this is why you would put the order through multiple trading desks. And I would imagine that Camelot would trade a lot more, though, than CRISPR in this pretend example, given Axe Capital's massive buy order. Quick side note. We always want the difference between the bid and the ask spread to be very narrow and as narrow as possible. And we only want to invest in very liquid stocks, meaning ones that trade a lot, or else we end up pushing the stock up when we buy it and vice versa when we sell it. In fact, a lot of hedge funds went belly up in the fall of 2008 because they could not sell their illiquid stocks fast enough, and illiquid stocks own us in a down market instead of vice versa. And I always recommend never buying a stock if you're more than 10% of the daily trading volume. So in the case here with CRISPR, since the daily dollar amount traded is massive at $240 million, then I would not recommend that a professional money manager buy more than a $24 million position in this company. Now, how much did Axe end up investing in this stock?
Camelot Biochem. Go long 200 million.
So he likely ended up buying the rest of the order on another day. Now, how much did he make on this $200 million investment?
Camelot Biochem is getting acquired by Far East PNC at over $100 a share in cash and stock.
Axe is gonna make
Close to $100 million profit on a dirt trade.
Accurate, and here's why. He made $100 million on a $200 million investment, meaning a 50% return. Seems like a big premium, but not in biotech, as the average M&A premium in biotech was 61% in 2023. And if we search here for the word premium in this article, we see that the 50% premium is plausible. Topic 2, Occupy Wall Street. Why did the Occupy Wall Street movement exist? It's best summed up by this scene here where a judge is talking to Chuck Rhodes, who is the DA, meaning district attorney.
Optics matter. None of us, not the AG, not you, not me, none of us took down a single giant in the shadow of the crash of 08. I mean, maybe 1 or 2 mortgage brokers got kneecapped. Axelrod's the chance to cement you, big one.
Accurate. In 2008, we were within 24 hours of bank machines not working, and the government bailed out Wall Street with taxpayers' money. Then just 2 years later in 2010, Wall Street paid their employees record bonuses, while many people in the middle class lost their houses. That's not fair. And this led to peaceful protests on Wall Street and in other financial centers around the world. And as we can see here, there is an Occupy Westport movement in this episode, as Axe office is in Westport, Connecticut, where many hedge funds are located. Of course, the protests in front of Axe Capital are more justified, given Axe's $750 million in profits on 9/11, as I discussed in episode 8.
This is bad.
Hey, I don't show up at your job screaming and waving signs about how much you suck. Oh yeah, that's right. You don't have a job.
Okay, there's no way an Axe employee would yell at the protesters. Axe Capital Management would tell all employees not to talk to the protesters. And in most finance company, you're told never to talk to the media or in special situations like this. Topic 3. Axe employees start to leave as Axe investors start to redeem.
Raul.
I'm really sorry, my friend. You know I'm not just saying that, right? The 90 days, if it helps, you can take longer.
No, you don't even have to wait for your redemption period. I don't hold hostages.
Accurate. If you want to take your money out of a hedge fund, you have to give advance notice. Now, the bigger the fund, the longer the required notice. And so 90 days is realistic because Axe Capital is massive. It's over $10 billion. And smaller funds would get 30 days notice from investors. Now, given the fact that Axe is getting massive redemptions due to 9/11 profits and insider information allegations, this happens.
It feels like jumping ship at exactly the moment the ship is going to sink.
That is the time to do it.
Accurate. Most hedge fund employees think with their wallets. Although the largest hedge funds have golden handcuffs to make you stay by making you defer part of your bonus for a couple of years, which the firm invests back into the company. And if you leave early, then similar to lost stock options, you lose your deferred compensation. Also, larger hedge funds often make you sign a massive legal contract when you join, which has a 1-year non-compete, meaning if you quit and you go to a competitor within 1 year, then you lose all of your deferred compensation. But if you work in California, where I live, then these non-compete contracts are usually not enforced by the courts. So here in California, even if Google made you sign a non-compete and you joined a Google competitor, then Google cannot enforce the non-compete, which is one reason why there's so many startups here in the San Francisco Bay Area. Now, it's quite different in other states. For example, if you worked for Amazon in Washington State as an engineer, you might not be able to quit and then join Microsoft as an engineer within 1 year of quitting Amazon, or you could lose deferred compensation. and this partially explains why there aren't more tech startups in Washington state. Let's talk about grading this episode for Wall Street realism with a buy, hold, or sell rating. Although the Camelot 50% M&A premium is plausible, the fact that a portfolio manager and not a trader would submit one massive order is not realistic. Ideally, the order would be executed by the trader through multiple sell-side trading desks. Separately, the Occupy Westport movement is believable and commensurate with the Occupy Wall Street movement, but there's no way that an Axe employee would yell at protesters who have a good reason to protest. On the other hand, the redemptions issue and the immediate loss of personnel is realistic, as similar to Bobby, his employees tend to think with their wallets. As a result, I'm going to give this episode a hold rating. Please like, comment, and subscribe, and I will see you soon in our next reaction video when we react to episode 10. Thank you.